Welcome to the deep dive. Today we're digging into TPG RE Finance Trust, TRTX. We're looking at how they're navigating, well, frankly, a pretty tough commercial real estate market.
Yeah, it's definitely choppy out there. But their Q2 2025 earnings call from July 30th gave some really interesting insights.
It really did. We heard from CEO Doug Bouquard and CFO Bob Foley, but before they got into the numbers, the call started on a more somber note.
That's right. Doug Bouquard paid tribute to Wesley Leitner from Blackstone, a really respected leader in the industry, tragically lost.
Yeah, he spoke about her talent, her kindness. Just a very human moment, a reminder that there's more to all this than just finance.
Absolutely. It was a poignant start. But then they shifted focus pretty quickly to the business. And what's interesting is how the results really seem to reflect a clear strategy in action.
Okay, so let's get into those results, because they were, well, pretty strong, weren't they? Especially compared to expectations.
They really were. GAAP net income hit $16.9 million. That's about 0.21 cents per common share.
Right, the standard measure. But for a REIT like TRTX, distributable earnings, or DE, is often what you really watch for dividends, right?
Exactly. And DE per share came in at 24 cents. The consensus estimate was, what, 22 cents?
Yeah, 22 cents. So they beat that by like 9%. That's a solid beat.
Definitely. And revenue was also a bit ahead of expectations, around $36 million versus a consensus of $35.6 million.
Okay, and book value. That's always a key one.
It ticked up slightly, just a penny, to $11.20 per common share.
Yeah.
But, in this market, even flat or slightly up is pretty good news.
No kidding. So with DE at 24 cents, did that fully cover their dividend? I think they declared 24 cents as well.
It did, yeah. The $1.24 dividend was fully covered. That's obviously crucial for income investors. Provide some comfort there.
And the market liked it.
Seems so. The stock saw a nice bump on July 30th, closed higher, and the volume was up too. So yeah, investors seem pleased with the execution.
All right, so good headline numbers, happy market reaction. Let's dig into how they got there. They talked a lot about this deployment and de-risking strategy.
Yeah, that was the core theme, deployment and de-risking. It's about putting new money to work in smart ways while also, cleaning up potential problems in the existing portfolio.
Kind of playing offense and defense at the same time.
Exactly. And it seems like they're finding opportunities because others might be pulling back, that counter-cyclical thing.
Okay, so let's talk deployment first. They closed quite a few loans this quarter.
They did. 7 first mortgage loans, totaling almost $696 million in commitments.
Wow, that's a big number. What kind of loans were these? What were the terms like?
Pretty attractive, it seems. The weighted average spread was term SOFR plus 2.86%. So a decent return over the base rate.
Okay.
And they had interest rate floors averaging about 3.12%, which protects them a bit if rates were to fall somehow. The loan to value, the LTV, was around 67.6% on average. Pretty conservative.
So not overly risky lending. And where were these loans focused? Which property types?
Heavily concentrated in multifamily and industrial. Those are the sectors everyone sees as more resilient right now. This activity grew their whole loan portfolio by about 15%.
15% growth, focused on multifamily and industrial. That sounds like a very deliberate strategy. Are they just filling the gap left by banks?
It seems to be a big part of it. Traditional banks are more constrained, regulatory pressures, market jitters. They're pulling back from direct lending in some areas.
Right.
So that creates this window for lenders like TRTX. They have the capital, the dry powder, as they call it, and the structure to step in and get good deals, good spreads on quality assets.
So it's not just about deploying capital, but deploying it smartly where others maybe can't right now.
Precisely. It's a real competitive advantage if you can execute it well.
And besides new loans, they were also active on the capital return front, weren't they? Share buybacks.
Yes, definitely. They bought back about 1.66 million shares, spent $12.5 million, average price 7.52 cents.
Which is well below that book value of $11.20 we mentioned.
Exactly. So buying back shares at that discount directly adds to, or accretes, book value per share. In this case, it added about 0.08 cents per share.
And they still have room to do more.
Yep. They mentioned about $9.3 million left in their current buyback authorization. So it signals confidence, and it's another way to boost shareholder value.
Okay, so that's the deployment side, new loans, buybacks. What about the other side, the de-risking? Especially with REO, the real estate-owned assets.
Right. This is where it gets really interesting, especially given all the anxiety around commercial property, particularly office.
Yeah, absolutely.
They sold 2 office REO assets. This is key. They got net proceeds of about $39.4 million and actually booked a GAAP gain of $7.0 million on those sales.
A gain on office REO sales in this market. That's impressive.
It really is. And the big impact is it slashed their office REO exposure. It went from around 5% of the balance sheet down to just about 1%.
Wow, only 1% office REO. That significantly changes their risk profile.
Hugely. Their total REO exposure is now down to about 5% of assets overall. And the bulk of what's left, about 74% of the remaining REO, is multifamily.
Which, again, it fits that theme of focusing on more resilient sectors.
Exactly.
Yeah.
And they signal they're not done. They plan to launch sales processes for more REO assets in the coming quarters. So this de-risking is an ongoing thing.
Beyond just the REO, how's the health of the actual loan portfolio looking?
Remarkably stable, actually. Still 100% performing. And the weighted average risk rating has been steady at 3.0 for 6 quarters straight now.
6 quarters at 3.0 and 100% performing. That really speaks to their underwriting and management, doesn't it?
It certainly suggests strong credit quality, especially compared to the broader CRE market where you're seeing more stress.
And how does that translate into their allowance for credit losses, the CECL reserve?
It actually decreased. Went down to 176 basis points from 199 basis points last quarter. That's about a 12% drop.
Okay, so lower reserve. Does that mean they're less worried?
Well, management framed it as reflecting the 100% performing status and the portfolio growth. They also specifically mention that their current CECL estimates already factor in forecasts for things like interest rates, inflation, GDP.
Okay.
And based on those forecasts, they don't expect those macro factors to cause major issues with the reserve or credit migration down the line.
So they feel like they've already baked in a reasonable amount of caution for the future.
That seems to be the message, yes. They believe their current models capture the potential risks adequately, suggesting a forward-looking approach rather than just reacting.
That confidence in the loan book is one thing, but liquidity and funding stability are just as critical, especially now. How do they look there?
Pretty solid. Liquidity was strong at about $236 million. That's cash, plus what they can draw down. But the really important piece, I think, is their financing structure.
What about it?
They increased their non-mark-to-market financing. It's up to 95% of their secured debt now, from 91% before.
Okay, unpack that a bit. Why is non-mark-to-market so important? It means the value of the collateral backing their debt isn't constantly being reset based on potentially volatile market prices. So if property values wobble, it doesn't automatically trigger margin calls or force them to sell assets at bad prices.
I see. So it insulates them from market swings, provides stability.
Exactly. Huge stability benefit in uncertain times like these. It significantly contains liquidity risk.
Makes sense. Did their overall leverage change much with all the new loan activity?
It ticked up a bit, yeah. Total leverage went from 2.2 times to 2.6 times, but that was really to fund that 15% loan growth we talked about.
So manageable increase, given the context of growth and de-risking.
Seems that way.
Yeah.
It looks like calculated leverage to support strategic growth, not a sign of stress. And they were smart about funding it too, using reinvestment capacity from one of their existing securitizations, TRTX 2025 FL6.
Recycling capital.
Precisely. Making existing funding work for new opportunities. About $172 million came from that.
Okay, so strong quarter, strategic moves paying off, stable funding. What's the outlook? They mention an elevated pace of new investments.
Yeah, elevated. That suggests they plan to keep their foot on the gas, deploying more capital in the coming quarters. They highlighted having over $200 million in newly executed term sheets already, plus a pretty extensive pipeline behind that.
And how are they funding this continued deployment?
It's a mix. Using that available dry powder, tapping more CLO reinvestment capacity, recycling the cash from these REO sales we discussed, and potentially more opportunistic share buybacks. It's like a cycle.
Makes sense. Are they sticking to the same investment themes, still multifamily and industrial?
Primarily, yes. Those remain the core focus. They did mention some interest in other areas like student housing, which can also be pretty resilient.
What about the type of deals? Is it mostly refinancings or new acquisitions?
Right now, the pipeline is mostly refinancings. Management said they hope to see more acquisition financing opportunities pick up as, maybe interest rates stabilize a bit and buyers and sellers can agree on pricing more easily.
So the current pipeline reflects the market uncertainty, but they're ready for acquisition activity when it returns.
That seems to be the plan. And they still sound very positive on multifamily fundamentals for the next year or two. They pointed to slowing new construction, high mortgage rates keeping people renting, and supply getting absorbed in some markets.
Okay, stepping back, how does this TRTX story fit into the broader commercial real estate picture for you listening? It's still a very divided market, right?
Absolutely. Bifurcated is the word often used. Multifamily and industrial are holding up relatively well, but office is still facing major headwinds. TRTX's strategy is clearly designed to play into that strength and avoid that weakness.
And they're benefiting from banks pulling back.
Definitely. That bank retrenchment creates a real opportunity for non-bank lenders like TRTX to step in and originate loans with good terms, good spreads, especially in those favored sectors.
So for you, the stability factors are that high non-mark-to-market funding, strong liquidity. It gives them predictability.
A degree of predictability, yes,
Right.
and a very unpredictable market. That 95% non-mark-to-market funding is a significant cushion against volatility.
And we saw the market react positively on the earnings day. How has TRTX performed against benchmarks more recently?
Quite well, actually. Over the last 1 month and 3 months leading up to the call, their total return significantly beat both the S&P 500, SPY, and the REIT benchmark, RAM.
Okay, what were the numbers?
1 month, TRTX was up about 7.3%, while SPY was up 3.0% and RAM 1.3%. 3 months, TRTX was up a huge 23.4% versus 8.0% for SPY and 4.2% for RAM.
Wow, big outperformance recently. They lagged over the full year, but that recent momentum is strong.
It really suggests investors are buying into the strategy execution. The deployment, the de-risking, the stable funding, it seems to be resonating.
So what are the key things for you to watch going forward? What are the potential catalysts?
Keep an eye on execution of that pipeline. Can they maintain that elevated pace? Watch the ongoing REO sales. Can they keep selling, hopefully at gains? And obviously, sustained dividend coverage from distributable earnings is critical.
Right. Continued strong origination and keeping that office exposure minimal seem key for maybe growing book value over time, too.
Absolutely. Those are the drivers for potential gradual book value accretion and stable income.
Okay, let's shift gears to our not financial advice segment. That wild but maybe plausible trade idea, given everything we've discussed, what are you thinking?
Well, TRTX is still trading at a pretty big discount to its book value, right? You said around 25%.
Yeah, about 25% below that $11.20 book value, despite the 100% performing loans, the de-risking, the pipeline.
Okay, so here's the thought experiment for you. What about going long TRTX, capturing that potential discount closing and the dividend, but pairing it with a short position?
Shorting what?
Maybe shorting a broad commercial real estate ETF that's heavily weighted towards legacy office, or even shorting a specific, maybe more challenged office REIT.
Ah, the relative value play. Betting on TRTX's specific strategy against broader sector weakness, particularly office.
Exactly. The idea is TRTX's active management, their focus on multifamily industrial, the capital recycling, that allows them to potentially keep building value, closing that discount.
While the office-heavy parts of the market might continue to struggle or even erode further.
That's the thesis. You're betting on TRTX's superior credit selection, their liability management, their de-risking success versus the less nimble or more troubled parts of the CRE market.
So if that elevated pace of investment continues and the REO sales keep coming, maybe even at gains, that 25% discount could shrink.
Potentially, yeah. It's a play on management execution continuing and the market recognizing that relative strength. It's definitely not without risk, but it highlights that divergence within CRE.
It's a fascinating idea. It definitely hinges on continued execution. Okay, so to wrap things up.
Well, TPG RE Finance Trust, TRTX, they really delivered a strong Q2. You saw effective capital deployment, strategic de-risking, especially getting out of office REO, and a clear focus on shareholder returns through dividends and buybacks.
Yeah, they're focused on those resilient sectors, multifamily and industrial, plus that stable funding profile with high non-mark-to-market debt seems to position them, well, pretty well in this tricky environment.
Agreed. But as always, remember this discussion is just for informational purposes. It's absolutely not financial advice.
Definitely not. Please do your own research. Consider your own circumstances before making any investment decisions. Commercial real estate finance is complex.
Very true.
So thanks for tuning into the deep dive. We'd love to hear your thoughts. Do you think TRTX has the right formula with this deployment and de-risking? Or are there other risks lurking out there? Let us know. We'll be back soon with our next deep dive.